Welcome to Chapter 5 of the Clever Framework, where we explore the fourth essential step, verify the results. This is where professional skepticism transforms into action. Before trusting any number or explanation, no matter how confident the source appears, you must check the math, follow the audit trail, test internal consistency, and compare results across periods. Verification goes beyond simple recalculation. It includes evaluating whether the correct accounting concept was applied, whether relationships across statements make sense, whether trends align with economic reality, and whether additional evidence is required to confirm or refute a claim. This chapter will show you how verification strengthens judgment, exposes errors, and provides the foundation for reliable, defensible conclusions. Let's start with a deceptively simple scenario. A student analyzes an income statement showing revenue of $48,000, expenses of $55,000, and net income of $10,000. She writes her summary confidently until an instructor circles two numbers and writes one comment in the margin. Verify your math. She subtracts expenses from revenue again and realizes the company actually lost $7,000, not earned $10,000. The statement wasn't complicated. The totals didn't hide anything. She simply trusted the numbers as presented and didn't check them. Even the simplest analysis fails when results aren't verified. This example shows that verification isn't just for complex scenarios. It's essential for every number, every time, regardless of how straightforward the information appears. Professionals face the same trap in more complex settings. During a monthly review meeting, a finance major presents a glowing report showing strong profit growth. The CEO is pleased and ready to celebrate until the CFO quietly says, "Let's trace the numbers back to the source." When the team follows the trail, they discover that a spreadsheet link referenced last quarter's data instead of the current period. What looked like a profit was actually a loss. No one had verified the formulas, the totals, or the data source. In an instant, the tone of the meeting shifts from celebration to concern. The presentation itself wasn't intentionally misleading. The underlying calculations were simply wrong. This scenario illustrates why verification is critical. Numbers can be copied incorrectly. Formulas can reference wrong cells or periods. Data can come from outdated reports, and even well-intentioned colleagues can introduce errors by accident. Without verification, you risk basing conclusions on flawed information. There are four primary ways that numbers fail when verification is skipped. First, they're copied incorrectly. Manual entry introduces transcription errors that change the entire story. Second, wrong formulas are used. Spreadsheet links reference incorrect cells or periods, pulling last quarter's data when you need current results. Third, wrong periods were selected. Data gets pulled from outdated reports or mismatched timeframes. And fourth, AI fabrication occurs. AI tools generate convincing explanations that lack any basis in actual financial statements, sounding authoritative while being completely wrong. Each of these failures is preventable through systematic verification. The question isn't whether errors will occur, it's whether you'll catch them before they lead to flawed decisions. The verify step involves four essential techniques. First, check the math. Recalculate totals, formulas, and ratios to ensure arithmetic accuracy. Second, follow the audit trail. Trace figures back to their original sources, whether that's journal entries, ledgers, or system reports. Third, test internal consistency. Reconcile amounts across statements and periods to ensure everything aligns properly. And fourth, compare results. Evaluate trends and assess reasonableness against prior periods, industry norms, and economic reality. These four techniques work together to create a comprehensive verification process. You're not just confirming that numbers add up, you're ensuring they make sense within the broader financial picture, align with accounting principles, and tell a coherent story across all the financial statements. Verification is the disciplined process that separates careful analysis from careless acceptance. Verification answers one fundamental question: is this correct? But when done well, it also answers three additional critical questions. Is it reasonable? Is it complete? Is it supported? These questions move you beyond simple arithmetic to true professional judgment. A number can be mathematically correct, but economically implausible. A calculation can be accurate, but based on the wrong accounting concept. A total can reconcile, but still be missing key components. Remember this principle. Financial decisions rely on trust, and verification preserves that trust by ensuring information is never accepted blindly. Whether you're reviewing a statement, assessing AI-generated analysis, or evaluating internal reports, verification transforms skepticism from an attitude into concrete action. Before trusting any number, no matter how confident the source, verify the math, trace the evidence, and test the logic. Let's break down the 4 essential verification techniques in detail. First, recalculate and reconcile. Foot and cross-foot schedules, recompute ratios and metrics, and reconcile balances across statements to ensure everything ties together. Second, trace to sources. Link figures to journal entries, confirm supporting documentation exists, and match disclosures to footnotes so you know where numbers originated. Third, verify concepts. Ask whether this concept applies here, whether treatments are correct, and whether relationships make sense within the accounting framework. And fourth, check consistency. Compare results to prior periods, analyze trends for unusual patterns, and review related accounts to see if they move together logically. Surprisingly, many misleading results stem from simple numerical errors or misapplied concepts. Even when AI generates calculations, you must confirm the results manually because confident presentation does not replace arithmetic accuracy or conceptual correctness. Certain patterns should immediately trigger deeper verification. First, if net income appears on the balance sheet, that violates fundamental statement relationships. Net income flows through to retained earnings, not as a separate balance sheet item. Second, if accumulated depreciation is treated as cash, that confuses accounting treatment. Accumulated depreciation is a contra asset account, not a cash flow. Third, if revenue growth is used to justify liquidity claims, that confuses profitability with cash flow. A company can have strong sales while facing a cash crisis. And fourth, if retained earnings decline despite positive net income, that requires investigation of dividends or adjustments. Something significant happened that needs explanation. These red flags don't necessarily indicate fraud or error, but they demand verification before you can understand what's really happening. When you spot conceptual impossibilities or logical inconsistencies, stop and verify before proceeding with your analysis. Let's examine a verification scenario. A student asks an AI tool, "Why did cash flow increase this year?" The AI responds, "Cash flow increased mainly due to improved operational efficiency and strong customer demand." This sounds convincing and reasonable, but is it accurate? Here's what verification reveals. The AI's generic answer mentions operational efficiency and customer demand with no specific line items and no evidence cited. These aren't even categories on the statement of cash flows, but the actual statement shows very different drivers. Lower accounts receivable, meaning customers paid faster, inventory decreases, meaning less cash tied up in stock, and deferred revenue growth, meaning advanced payments from customers. These are measurable, specific drivers that the AI never mentioned. The lesson is critical. AI confidence does not equal evidence. The AI generated a plausible sounding narrative without accessing actual data. Only the real statement of cash flows can explain cash movement. Verification protects you from accepting authoritative sounding explanations that lack factual foundation. Here's another verification scenario that initially seems puzzling. A company reports net income at $84,000, yet retained earnings decreased by $35,000, dropping from $65,000 to $30,000. At first glance, this doesn't make sense. How can you earn $84,000 but end up with less retained earnings? This is exactly when verification matters. Students often accept these numbers as provided, but the verify step urges deeper review. Verification reveals the answer. The company paid $110,000 in dividends, more than it earned during the period. Once you know this, the pattern makes sense. The company generated $84,000 in profit, but distributed $110,000 to shareholders, resulting in a net decrease of $35,000 in retained earnings. This example shows that verification goes beyond checking whether the numbers add up. It helps you interpret what the numbers mean and understand the story they tell when you connect all the pieces together. Let's review the 6 most common verification mistakes. First, trusting without checking. Simple errors hide in plain sight, and even basic statements can contain arithmetic or linking errors. Second, format over substance. Professional appearance doesn't guarantee accuracy. A neatly formatted statement can still be wrong. Third, trends as proof. Consistency doesn't confirm correctness. Rising income doesn't mean the numbers are right. Fourth, ignoring cross-statement alignment. When net income, retained earnings, and cash flows don't reconcile, that signals a deeper issue. Fifth, believing AI authority. Confident tone masks fabrication, and AI can sound authoritative while generating made-up explanations. And sixth, partial verification. Checking one part doesn't guarantee overall accuracy. You must verify the entire chain from source to summary. Each of these mistakes can undermine your analysis, turning potentially sound judgment into flawed conclusions. Verification requires discipline, thoroughness, and a commitment to checking everything, not just the parts that seem questionable. Professional skepticism in verification means maintaining 100% verification rate. Every number, every time, with 0 acceptable shortcuts and no exceptions to verification. This might seem extreme, but the foundation of trust in financial reporting. Verification transforms skepticism from an attitude into action. It separates careful analysis from careless acceptance and ensures that conclusions are grounded in evidence rather than assumptions. Before trusting any number, no matter how confident the source, how professional the format, or how plausible the explanation, verify the math, trace the evidence, and test the logic. This discipline protects you, your organization, and the stakeholders who rely on your work. Verification is not an optional step for complex scenarios. It's a core responsibility for every piece of financial information you encounter. When you commit to verifying everything, you build a reputation for reliability and accuracy that becomes a cornerstone of your professional credibility. Thanks for viewing this Clever Framework video. This video has been created and narrated by Dr. Wendy Tietz.